Welcome back. Investors around the world are still watching events in Washington, D.C. closely as Donald Trump prepares the team he wants to lead his second White House administration. Our next guest remains overweight equities and says the Trump presidency, the second Trump presidency, could have some positive impacts on the Canadian economy. Lesley Marks is Chief Investment Officer at Mackenzie Investments, and she joins us now. Thanks for coming in, as always.
Nice to see you again, Paul.
How should Canadian investors be thinking about the second Trump administration? So far, there's been a panic about tariffs.
Sure, and I think just to balance the statement, I think there are potentials for a positive impact on the Canadian economy, but there are also large potentials for risks to the Canadian economy, and we shouldn't ignore those risks. So first, let's start with the positive, which is, the Canadian economy is very much linked to the U.S. economy, as we know, given they're our most important trade partner. So any upside in economic growth in the United States should filter into Canada. That would be under normal circumstances. But of course, we're not headed into a period where anyone would describe as normal circumstances. And I do think that there is a lot of uncertainty that we are going to be faced as Canadians around policy, and in particular, of course, tariff policy for Canadian goods, which are a very important input to the U.S. economy. And in the context of higher tariffs, I think that will certainly, most certainly, have a negative impact on the Canadian economy. So I don't want to diminish those risks. I think that just right now, we don't have enough information. We have, a threat, and Canada is entering into what will be a very active negotiation with the incoming U.S. administration. Is it too early to predict what sectors of the Canadian stock market might do well on the back of a stronger U.S. economy? The two big rail stocks come to mind, for instance, CN and CP. Sure, and I think domestic-oriented Canadian companies that aren't really reliant on shipping goods cross-border will certainly get out of the crosshairs of trade. Unfortunately, that's few and far between. Most Canadian companies don't operate just in the domestic economy. The other issue with Canada, of course, and I hope that incoming President-elect Trump is considering this, but with a weaker Canadian dollar, our goods become much more attractive from a price perspective to the U.S. buyer. And that the same could be said for Canadian companies. So leaving politics aside, what is your view now of Canadian stocks after this very, very strong year that the composite has had? So I think that Canadian stocks, as you probably know, are not always aligned with how the Canadian economy is doing. So if we just look at the Canadian economy, we would say, it's been a fairly weak economy for a year and a half, and so it's been a bit surprising. You would say Canadian stocks have probably been punching above their weight. The reality is you have to sort of break down where the big leverage points are here in Canada. And they're the fairly obvious one: the financial services sector, the energy sector, the materials sector. So those three sectors are really drivers of Canadian stocks. Gold has been a key driver in the materials sector and driving that sector a lot higher. And more recently, what we've seen in the energy sector, although oil has been in a very tight trading range, is natural gas has really surfaced up as a very important strategic commodity when it comes to building out energy infrastructure, LNG, et cetera, around the world. On the financial side, obviously, we've had a good discussion already this morning around the reporting of the Canadian banks. And the real question will be, are we sort of through, the market is forward looking, so are we through the worst when it comes to provisions for credit losses for the Canadian banks? What is your view of multiples of the Canadian bank stocks? Our guest, Dan Rohinton, looked at Royal, says he loves the bank, loves the results, doesn't love the multiple of nearly 14 times expected earnings right now. He thinks that stock is expensive. He would hold off on adding it to his portfolio. Other bank, there are different PE multiples through the group, but some of them, I think National would be included, are now trading pretty richly. Well, I would say instead of looking at individual stocks, thinking about multiples in aggregate, typically multiples expand when you see improving sentiment and a decline in interest rates. So let's unpack both of those things. First of all, interest rates we think will continue to decline here in Canada, despite what we're seeing south of the border of a recalculation around how low interest rates can go. We think the Bank of Canada continues to cut rates. So that's going to be good for multiples overall for Canadian stocks. The second thing is about sentiment. Right now, sentiment is actually very strong. There really just doesn't seem to be a sense that there are risks on the horizon. And we know that's factually incorrect because there are policy risks that we cannot necessarily analyze and factor into stocks today because we don't know exactly how the next year is going to play out from a policy perspective from the most important economy in the world. So I think that creates a bit of a headwind for multiple expansion. And really the growth that we're going to see in stock prices, including for the banks specifically, is really going to come from earnings growth, less than multiple expansion.
Okay, we're out of time, and I haven't left enough time for you to talk about your overall posture on equities, but you're overweight equities right now, and you favor U.S. stocks, correct?
That's right. And the thesis is, you know, what we talked about, positive growth coming from the policy in the United States. And then the second part is a broadening out of exposure in the U.S. beyond the Mag 7.
Thanks a lot, Lesley.